Ever wondered which Canadian dividend ETFs might be the best fit for your investment portfolio? Welcome to our deep dive into the world of Canadian Dividend Exchange Traded Funds, or ETFs, a must-know topic for any savvy investor. ETFs are essentially investment funds traded on stock exchanges, much like individual stocks. But the beauty of ETFs is that they offer diversified exposure to a specific corner of the market. In our case, we're focusing on those that pay dividends, a steady stream of income that can be a real game changer for your investment strategy. Today, we'll be shining a spotlight on three top-performing Canadian dividend ETFs, XIC, VDY, and XEI. Each has its own unique strengths and annual yields, offering a variety of options for investors. So, whether you're a seasoned investor or just starting your journey, this is information you won't want to miss. Stay tuned to learn more about XIC, VDY, and XEI. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First up, we have the iShares Core S&P/TSX Capped Composite Index ETF, also known as XIC. Let's delve into the details of this fund. XYC seeks to replicate the performance, net of expenses, of the S&P/TSX Capped Composite Index. This index is a benchmark for broad diversified exposure to Canadian equities. XYC holds a diverse mix of large, mid, and small-cap companies spread across various sectors, with a slight tilt towards financials and energy. This wide diversification means that XYC captures the full breadth of the Canadian economy, which can offer a certain level of stability. But remember, diversification does not guarantee against loss. Now let's talk numbers. The annual yield of XYC has been pretty impressive. As of the end of last year, it was about 2.5%, which is quite competitive compared to other ETFs in the market. This yield is the amount of cash flow you're getting for every dollar invested in the fund, so it's a critical metric for dividend investors. One of the key selling points of XIC is its low expense ratio. At only 0.06%, it's one of the cheapest options for Canadian equity exposure. This means more of your investment goes towards growing your wealth rather than paying fund management fees. But what makes XYC a good choice for some investors? Well, if you're looking for a simple, cost-effective way to get broad exposure to Canadian equities, XYC is a pretty solid bet. It's a versatile fund that can serve as a core holding in a diversified portfolio, providing a solid foundation upon which to build your investment strategy. However, it's important to note that XIC, like any investment, carries risk. The fund's performance is directly tied to the performance of the Canadian economy. So if Canada's economy takes a hit, so too will XIC. XIC is a solid choice for many, but what about VDY and XEI? Let's find out. Next on our list is the Vanguard FTSE Canadian High Dividend Yield Index ETF, or VDY for short. Now let's dive right into the world of VDY. This ETF's primary purpose is to track the performance of a broad Canadian equity index that focuses on high dividend-yielding companies. In simpler terms, it's a tool that allows investors to gain exposure to a wide range of Canadian companies that consistently pay out high dividends. Now, you might ask, what are the companies that VDY holds? Well, it's a compelling mix of sectors, with a strong weighting towards financials and energy companies. Some of its top holdings include household names such as Royal Bank of Canada and Toronto-Dominion Bank, companies that have a long history of paying steady dividends. Let's talk about performance. Over the past 5 years, VDY has shown a solid track record with an annual yield of around 4%. To put that into perspective, that's a higher yield than the average Canadian ETF. This is one of the reasons why VDY holds a special place in the portfolios of many income-focused investors. But it's not just about the numbers. The appeal of VDY also lies in its diversity. By investing in VDY, you're not just putting your money in one company or one sector. You're spreading it across a range of sectors and companies, which can help to mitigate risks. So why might VDY be a good choice for certain investors? Well, if you're looking for a steady stream of income through dividends, VDY might just be your ticket. It offers a higher than average yield and gives you exposure to some of Canada's top dividend-paying companies. VDY offers some unique benefits, but don't make your decision just yet. We've still got XEI to cover. Last but not least, we have the iShares Core S&P/TSX Composite High Dividend Index ETF, better known as XEI. Now, let's dive a little deeper into the world of XEI. This ETF is all about providing long-term capital growth by tracking the performance of the S&P/TSX TSX Composite High Dividend Index. In layman's terms, it's a fund that focuses on Canadian companies with a knack for paying high dividends. XEI's portfolio is a diverse blend of companies from various sectors, creating a balanced investment opportunity. You'll find everything from financial giants and energy behemoths to real estate trusts and telecommunication leaders. This diversified approach is a key strength of XEI as it helps mitigate risks and offers a steady stream of income. But you're probably wondering, what's the annual yield? Well, buckle up, because XI has consistently posted an impressive annual yield. Over the past 5 years, it's averaged around 5%. Yes, you heard it right, 5%. That's a return that can make a noticeable difference in your investment portfolio. Now, how does XI stack up against other ETFs? Well, when compared to our previous ETFs, XIC and VDY, XEI holds its own. While XIC offers broader exposure to the Canadian market and VDY focuses on high-yielding Canadian stocks, XEI strikes a balance, providing a high dividend yield while maintaining a diversified portfolio. So who should consider investing in XEI? If you're an investor seeking a reliable income stream and you're comfortable with moderate risk, XEI could be a good fit. Its high dividend yield and diversified holdings make it a strong choice for those looking to build wealth over the long term. But remember, every investment comes with risks, and it's important to do your own research or consult with a financial advisor before making any investment decisions. XEI rounds out our top 3, but before we wrap up, let's do a quick comparison. Now that we've explored each ETF individually, it's time to see how they stack up against each other. Let's start with their annual yields. XIC, with its broad market coverage, offers a yield around 2%. VDY, focusing on high dividend yielding Canadian companies, provides a yield around 4%. XEI, with its exposure to both large and smaller companies, sits in between at around 3%. Now let's look at their holdings. XIC holds over 250 companies, giving it a broad exposure to the Canadian market. VDY, on the other hand, is more concentrated, holding around 50 high dividend yielding companies. XEI strikes a balance with about 75 holdings, but leans towards the energy sector. In terms of performance, all 3 ETFs have shown resilience over the past few years. XIC, being the broadest, mimics the overall performance of the Canadian market. VDY, with its focus on dividends, has shown strong returns during periods of market stability but can be more volatile during downturns. XEI, with its tilt towards the energy sector, has shown variable performance, depending on the health of that particular industry. So, which ETF is the best choice? Well, it depends on your investing goals and risk tolerance. If you're looking for broad exposure to the Canadian market, XIC may be your best bet. If you're after high dividends and can stomach some volatility, VDY could be the one for you. And if you're willing to bet on the energy sector with a mix of large and smaller companies, XEI might be worth considering. Remember, all investments come with their own set of risks and rewards. It's crucial to understand these before making any decisions. No matter which ETF you choose, remember that investing always involves risk. There you have it, a deep dive into XYC, VDY, and XEI, 3 of the top Canadian dividend ETFs. We've explored the distinct features of each, their annual yields, and how they stack up against one another. Remember, XYC offers broad exposure, VDY focuses on high dividend yielding companies, and XEI is a blend of both high yield and broad exposure. While these ETFs are a great starting point, it's crucial to remember that investing should never be a hasty decision. Conduct your own rigorous research, consider your financial goals, risk tolerance, and investment horizon. Seek professional advice if needed, and ensure that your investment decisions align with your individual circumstances. In the grand scheme of things, remember that knowledge is power. The more informed you are, the better your investment decisions will be. If you found this information helpful, don't forget to subscribe, like, and share this video. Stay tuned for more insightful content.